All right. Hello, everybody. Welcome to another episode of the Napoleon and Gueco podcast. How are you doing today, Gueco?
Fabulous. How are you doing, Napoleon?
Pretty good. Pretty good. So, what have you been up to lately with your YouTube channel?
I haven't been posting as much as I was at the beginning. I've been doing trading videos, basically trading live on YouTube and trading the Nasdaq, mostly an evaluation. Have you ever heard of a prop firm?
I'm pretty sure I've heard the term before, but I don't really know much about them.
Quick thing is it's these companies that basically you pay a monthly subscription and you have an evaluation. The one I'm taking, for example, it gives you a 50K balance that you have to bring up to 52,500. So basically you have to make 2,500 in profit, and it only gives you a maximum drawdown of $2,000. So if you lose $2,000, you lose the evaluation. If you pass the evaluation, you become funded, basically, if you do pass it. And once you're funded, you still trade on a sim account with the $50,000 balance. But now the profits that you make, you actually can cash out and make real money. So it's a really good way to get started and learn without having to put in your own cash capital as risk. I've been doing that evaluation on my channel. I'm basically just learning a lot for the past year. I am happy to say that I've made a lot of progress. I was in one competition as well, which had about 70,000 participants. And at the end of the competition, just by having about $200 in profit, I was at the top 10% of the participants. So that tells you how hard this is and how much people lose in the markets. During the evaluation, I had about $1,000 in profit, and that put me in about 5% of the participants. Of course, the winners are also kind of freaks on their own nature. The winner of the competition ended up making about, 40% of the initial money. So they made a 40% profit at a $250,000 start. That added up to $150,000 in profits. This is all same accounts, by the way. This is not real money, but it's a way to learn to trade different assets and different currencies. You could trade Bitcoin on that specific competition. And the winners get $25,000. Second place gets like $10,000. And so on. The first 10 places get cash money prize. So it's a really cool way to learn. I've been learning how easy it is to lose money in this endeavor.
It's very easy for me to lose money in so many cases, and that's why you don't want to just go into trading, whether it's in the stock market or in cryptocurrency, unless you really know what you're doing or you have somewhat of a background, or at least have done some of your homework on trading.
Some experience,
because
for sure.
Part of my problem was how I got screwed over with cryptocurrency and ended up losing some money off of it was someone told me, hey, Bitcoin is going to go up to 100,000 within the next year. So hurry up and get into it now. Just start putting hundreds of dollars into it, maybe thousands. And with me, I'm not the type of person that, I don't gamble a lot. But if I do, I'm not just going to go all in. I'm not going to cash all the chips towards one thing.
Right.
But at the same time, I still ended up losing some money because I was thinking, oh man, I thought I was going to increase whatever I put into Bitcoin by like 5 times. I put in like $500, I come out with 2,500. That didn't happen. I mean, sure, it did end up going up to like maybe 50 or 60,000 around like when the pandemic was still a thing. But I didn't really realize the hard way, but definitely had to experience it after a failure. And what made me realize something that some people may not notice when it comes to trading is that you can't really treat it the same way as gambling. That if you get in, you buy a cryptocurrency or you buy a stock that you want to be the next Amazon and you just want to cash in on it just so that way when it goes up, you're just going to make this huge profit. That's really just another form of gambling. And you should not really think of investments and trading like that, or you should not go in with that attitude, because if you want to make money, you have to invest in the long term. And when you're just doing those gambles, that's only short term investments, in my opinion.
Well, the day trading itself, it's a kind of a little bit of a different beast than buying a stock, believing in a company or some kind of product that's going to elevate the price of the stock and cashing in down the line in the long term. Day trading, a lot of times you use leverage or margin, which can greatly increase the amount of profit you can make in one day, but also does increase your risk.
I mean,
yeah,
risk
I like to
is
trade
always
futures
proportional
myself.
to reward.
Futures contracts, the Nasdaq moves 5 points, which is, a little bit of movement that happens in 10 seconds. You can lose $100 in one contract, or you can lose $1,000 in 10 contracts just on that 5-point movement, which happens in seconds. So it's a skill that definitely requires a lot of experience if you're going to be doing it as a job, which is what I want to do. I basically want to do it as my full-time thing. Like I said, I've been getting better at right currently in my evaluation. I have to hit that 2,500 profit. I've been at it for 5 months. I do pay every month in order to keep the valuation going, and I failed about 4 or 5 times, but now I am still in it. Right now I'm about $1,000 in profit, so I have some room there to finally make it happen. And I've definitely been learning a lot. Think about this, okay? I'm gonna give you like a quick strategy type thing, okay? Let's do trades. Yeah, let's just stick with it. But think about this, okay? So let's say you're playing a game or a trading, you're trading, and you risk $100 to make $100, right? Every time you buy or sell, you're risking 100 to make 100. And let's say there's a 50-50 chance that you get it right. So you go in during the day, and your goal is to make 3 moves. 3 moves of $100 risk reward each. But here's the caveat. Win the trade, the next one you double down. So you risk 200 to make 200. So if you do this and you take every day 3 trades, let's say for 10 days, some days you're gonna have win, win, win. Some days you're gonna have win, lose, win. Some days you're gonna have win, lose, lose, and all those different scenarios, right? Some days you're gonna have lose, 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 right? But if you double down every time you make one good trade, your maximum profit could be $400. Because if you win, 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 you win one, 100. You win the second one, which you double down, 200. So now you have 300. And then you win the next one, that's 400. But when you lose, 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 you can only lose 300. This is just a strategy, a game strategy for any game. It could be the Vegas game or any type of.
Same thing. You could have that same strategy with blackjack and roulette.
Right.
But at the same time, what if you win, win, lose? You still leave like losing $100. You double $100.
No, if you win, win, lose, you break even. You don't lose any money. You win 100, you double down on the next one, you lose 200. So you basically don't make or lose.
Well, you lose that 100 you bet in the first place.
No.
You bring $100 to the table.
You said win, win, lose? Is that what you were saying?
I was saying like win, win, lose. Let's say you bring $100 chip to the blackjack table. You double it to 200, and then you double that to 400, but then you put all that on and lose it. You still lose.
The strategy I'm talking about, you only double down when you win the previous one.
Okay.
And only one time. So it's not like if you win one and then you win the next one, then the third one again, you double down. No, you only double down one time when you win the next one. So if you win, win, lose, it would be 100 plus 200 minus 100. So it would be a $200 profit. Does that make sense?
It's not like Mark Wahlberg in the movie The Gambler, where he
it's not like you double down every
2,000
single time you win,
and then doubles it to 4,000. Then he bets it all, trying to win 8,000, and just loses it all.
That's one strategy, for example, that could work. That just makes the numbers work out a little bit on your favor, because, like I said, the worst days that are lose, 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 you can lose $300, and the best you can do is win, 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 which gives you $400. Now, of course, if you lose, win, lose, that's when the problem begins, because you lose 100, you win 100, and then you lose 200. So you basically lose 100 at the end of that. You actually lost 100. You lost 100. Well, no, actually, you lost 100, then you made 100, then you lost 200.
You still lose 200.
Exactly. Yeah.
Yes.
That's just one way to mitigate risk a little bit. I mean, there's millions of strategies that you can.
Oh, yeah.
But that's just one way that you can make it more sustainable. And also, if your win rate is more than 50%, and mine is, I mean, I don't mean to brag or to like say anything, but you know what my biggest strength is as of late, it's not really about getting more right and never losing. Like, that's not going to happen. This thing is so cruel, man. It'll take your money. The biggest like challenge or real skill that you need is to be able to close your computer. It's like you have a limit of how much you're gonna lose, and you literally only lose that, or
Exactly.
make. It's like have a plan on how much you're gonna make, on how much you're willing to risk, and
Right.
then if that gets hit, you stop trading. Like you literally turn off the computer. And believe it or not, it's not as easy as it sounds.
Oh, it's not. We've made it clear that investing and trading in the market should not be treated the same as gambling, but it's still the same thing in the casinos, is that you could be like, okay, I'm bringing $1,000. If I walk away from like the poker table and I lose it all, then I'm just leaving. I'm not gambling anymore. But then guess
Right.
what? You have that mindset like, ooh, maybe if I go play some roulette or some craps, I can get
Exactly.
some of it
Yeah.
back. And then, as we kind of mentioned in the first episode we did for YouTube, a lot of people come with that mindset, oh, I'm only going to lose this much. And then it obviously turns into, well, I think I'm going to win money. And then it turns into, I'm going to get some money back. And then it's like,
I'm just gonna get it
man,
back.
hopefully
And
I
it's
can
like-
just get back a percentage of what I
Right.
lost. And then it's like, well, if I can just get enough back to afford my return flight ticket, I'll be okay. That's kind of the problem, is that people really need to have some experience, or they need to have some knowledge of trading. And the reason that you win more than you lose is because you understand the market a lot better than the average person, or some random person who might just want to invest because they're
I
thinking,
would say that
oh,
it's not that I understand it
idea.
better, but I've been watching it for longer than most. I've been watching the charts
exactly.
for too long, and it kind of registers subconsciously even. Like I'll see the chart and I'll see graphs and stuff, and I'm able to make decisions, sometimes correct ones, based on watching it daily, day after day after day, and seeing it do things that it does every day. It doesn't really move that erratically. It does have certain patterns that you can pick up on, and then couple that with a good strategy, and then couple that with being able to turn off the computer. It could be a profitable business at some point. I'm not there yet to say that I can do this already and I'm a professional. I can't say that yet.
Right.
But I'm definitely on the way and getting better.
Yeah, it sounds like you're a lot better than I
Promising.
am at it. I'll admit, I'm still somewhat of an amateur when it comes to investing. I'm no expert, but I have done enough research to understand the
How it
different
works.
types of trading, the different types of funds or different things you can invest in. When it comes to the market, I use an app called Acorns, which is really good for someone who doesn't know a lot about the market, where you can go and buy stocks themselves if you want. What it recommends, and even there's somebody on YouTube, which I will provide the link to his channel in this video. His name is Graham Stephan, and he's the one who provided me
I know that, yeah.
most of the knowledge that I have when it comes
Yeah.
to trading and investments, and
Yeah,
kind
he's
of gave
good.
me a better idea of what to look for. Same thing with, like, he's who helped me find my current savings account, which has a better annual percentage yield than a lot of the other savings
Right.
accounts, a lot higher than the national average. But anyway, this Graham Stephan, his suggestion, which is the strategy I have used for everything that I have put in the market, what you got to do is something called dollar cost averaging. And he had a video where he actually ran some statistics from somebody who put a whole bunch of money into the market. They just kind of went all in on a certain stock or some certain funds. They ended up going down. They ended up
Yeah.
taking a loss for it, or they didn't really go up like they thought they would.
Yeah, because
And
you're stuck at a price instead of getting an average of the price movements.
Right. But they didn't do that. They were just trying to just, go for it.
Yeah, that's what most people do. They have $5,000 sitting there, and they're like, "Oh, I want to make money.
Yeah.
Let's put all $5,000 here."
Kind of like the roulette wheel. Let's just put it all on red.
Yeah, if I had $5,000 to invest right now on something, and I had an instrument that I wanted to put in, like, if there was a stock that I wanted to buy, what I would do is first I would do a lot of research on that stock for like a month or 2 months, even without even putting a single dollar still, just doing research and making sure it's the right decision. Then once I realized that I do want to invest in this and this is good for me and whatever, I believe in this project or whatever it is, then I would take those $5,000 and spread them in a whole year and periodically buy the dips, or not even the dips, but just periodically buy the stock, making sure that there's no alarming situations in those 12 months. Because let's say you put in about $2,000 in like 3-4 months, and then it dips down a lot. Well, then there's a good opportunity to get a little more for your bank,
Yeah.
for your money. And then if it does pan out and your analysis was correct and the price does go up, eventually you catch some of the dips and you mitigate the risk by dollar cost averaging. There's actually a website you can check out. It's really cool. It's called BTC, dollar cost average. It's like a calculator, and you can see what would have happened if you put in, let's say, $300 a month, $100 a month, or $1,000 a year, and it gives you the results that you would have had. And you always come out ahead, especially with things like Bitcoin that are very volatile.
Exactly, yeah.
And that they tend to go up in the long run.
Bitcoin, I think, is more stable than, of course, most of the cryptocurrencies, which is why most of the money I put on crypto was on Bitcoin. But it's cryptocurrency, you can't really trace it like you can actual money in the stock market. The one thing I was trying to say, and the interesting thing, which you're probably already aware of it, was that when he compared someone who put like a bunch of money on a stock or just went all in and then they kind of took a loss or it didn't go up as much, like 30 years later, maybe they had a little bit of a return, but it wasn't much. But then somebody, of course, who went in on a stock that turned out to do great, like 30 years later, it showed like, of course, they had a much better return than the first person. But then they ran statistics about somebody who just did dollar cost averaging on a stock or something like that, just whatever they were trading. Although they maybe did not put as much money as that one person did, maybe they didn't really invest or go all in on that one stock that the second person did well on, they still ended up with the most money out of like all three parties just with the dollar cost averaging. He couldn't really explain it mathematically, but just there's been one study after another showing that whatever you can afford, say if you can afford to set $100 a week aside from your paycheck, or even just like $20 a week, just do something. That's where they talk about a diversified portfolio, is that if you just want to go all in on one certain stock or fund, that's really not the way to go. And that's what Acorns does for a lot of their investors, because they know like, hey, we don't know a lot of stuff, and they provide you with like robo-advisors, but all you got to do is you decide, do you want to invest more conservative or do you want to be more aggressive? And you can choose like three that are like in between. So mine's like moderately aggressive, where it's mostly in stocks and funds that are more volatile, where sure there is more risk but more reward. But if you want to play it more safe, it could put some in like some bonds or some federal treasury bills, stuff like that, things that are more stable, that you won't lose as much money on, but you also won't have as much of a gain. And they also say, unless you're maybe like 70 or 80, that's the only reason to make your portfolio more conservative. You just want to make sure your money's okay. But if you're only like, 20 or 30, just go for it. You've got time on your side. Just start investing now and start to build up your portfolio. Just throw as much in as you can. And that's what I've been doing. I started off by maybe doing $25 a week, then I moved up to $50, then $75. I'm putting $100 a week in my Acorns account. And
that's awesome, man. That's awesome.
I don't have like a huge return right now, but it does show.
No, it will add up.
Time. You got to do it as a long-term thing, and it does show.
You got to do it as a habit and as a way to save money.
And it does show like 30 years from now, like the returns, they could possibly be higher than the amount of money you have actually invested in the account. Like it could actually be like right now, sure, the money you've contributed is maybe like 90% and your return is like 10% of your current balance. Right. Then it shows that like 30, 40 years down the road.
I mean, if time is on your side and you got 20 plus years, right, then also looking into dividend stock.
That's another reason that they say to go for the more volatile stuff, is a lot of stocks will pay dividends just as a way of saying thank you for investing with us.
Yeah, but there are differences between the dividends that some products provide and others. So sometimes the ones that give you the most dividend yield and they have more risky situations, they cannot keep up. So in the long run, they're not as good as some more conservative, stable dividend yields. And what happens with dividend is that because they're paying you, what you can do with that payment that they give you, even if it's like, I don't know, $100 a year at the beginning because you just started, that can buy you more shares. And then those shares provide more dividend, which then you use to buy more shares. That's what Warren Buffett called the snowball effect, where you roll a snowball and it's little, but
you reinvest your dividend.
It's huge.
Yeah.
So that can be for 20 years. That's exactly what I would do. Look for a good dividend yield, or maybe like 2 or 3 instruments, and especially that they have proven over the past decade or something to be stable. A lot of ways
Right.
that you can secure your future.
Down the road, that's definitely a good thing to look into, and I'm sure you can do a lot of stuff with Acorns. It's just they try to make it easier for people like me who don't really understand the markets like that well. Like, we're not a broker, we're not a
safe.
hedge fund manager, all that stuff. We want to invest, contribute a certain amount of money each week or each month, just some periodic thing, and also you have the option to where you run your credit card somewhere and you have it linked to your Acorns account. Say you make a purchase that after sales tax was like, $29.50. That other 50 cents will just round up and just.
I was about to ask you that because I
all
knew
those
Acorn,
transactions.
That's what it came out to do. It was like famous to doing that. Like
that's
getting
part of the
your
snowball
change.
effect. Even if it's just spare change, that
Exactly.
maybe if
that's
you
a
paid in
really great
cash,
idea. Actually, I didn't know that. I kind of thought that they weren't doing that anymore. Like I heard back when they came out and they did that, they were kind of revolutionary because people were like, "Oh, you can just purchase stuff and some amount just goes directly to your investments."
Right.
But I thought that they couldn't do it anymore for some reason and that they weren't allowed or something regulatory wise and that they stopped doing that. You're saying you can still do that?
You can still do that because I have been doing the roundup feature, and sometimes I'll even double
That's
it
awesome.
where it's like, hey, if I have a leftover 25 cents from a transaction on my credit card,
Hell
I'll
yeah.
just add an extra dollar, make it $1.25. And
It
I
adds
feel like
up.
that's part of the snowball effect, kind of like what you were saying earlier.
Sure.
Anytime stocks pay dividends, and like, I really don't know what exactly I own. I just know what percentage of my portfolio is invested in certain stocks, and I'll just see dividends popping up here and there. But whatever they are, I have it set to where they just get reinvested.
Awesome.
And so it does
it's
say
fun.
like over the years, like it doesn't seem like much now, but that's kind of the problem is that people get into the market, they'll see like the market's booming, the Dow's at an all-time high. They're like, oh, it's close to 40,000. I got to get in on this. But then guess what happens? I don't know when, and everyone will try to make predictions. Everyone's basically saying it's not a matter of if, it's a matter of when the next recession will hit, because we are long overdue for at least a correction. The Dow will drop maybe 10,000 points, maybe a little bit more. What kind of got me to change my mindset on investments was the pandemic, when the Dow was just dropping. It was like at 29,000. And then right when the lockdown hit, it just kept going down. A lot of that had to do with the fact that a lot of places were closed. A lot of companies were shut down temporarily for the lockdown. And that's why the market was crashing. And I was thinking, oh no, we're going into another depression. And some people told me this is the perfect time to get into the market. And I'm like, I'm out of work. I don't have a job. Like, all I'm getting is unemployment right now. I don't want to sacrifice that little money, in the market. What if I just lose it all? Like, kind of like in that recession in 2008 when people were like, that South Park episode where like Stan got $100. He wanted to go spend it. And then his dad was like, no, we want you to invest it in stocks. And then the guy was like, okay, let's put them in some funds here, here, and here. And it's gone. But that was the thing about the
gone.
2008. A lot of people's money was just disappearing and stuff because there was a market crash. I had the same feeling about the pandemic, but that was the whole thing that got me, was the whole volatile thing. Was like, hey, maybe I just find a high yield savings account that's playing it safe. People who've been around a long time, and that goes back to like what we mentioned in a previous episode, like with age comes wisdom. I know people who've lived through at least 2 or 3 market crashes or recessions. And they've told me, yeah, it sucked. It looked like they were going to lose everything. But when everything was down, when, everybody was panicking, because like a lot of people make the mistake of buying high and selling low. Like they're probably buying stuff because they're like, man, it's booming. I've got to get in on it. And then if there's another crash or a recession, they'll just panic and be like, oh no, I gotta sell everything now. It's either like, I just gotta take what I have left or just lose it all. But the people who've been doing it a while, the people who are thinking long term, they see it as an opportunity to be like, you know what? It's low, my returns are down, but I'm gonna see this as an opportunity to like invest more because everything's cheaper now. Like, it'll cost less to buy stuff right now. I kind of have the same mindset with sports betting. In the Super Bowl, I kind of went all in on Kansas City. And then at the beginning, when San Francisco was leading, they were like ahead 10-0. People are like, oh, looks like this is San Francisco's game. Like, you know, Kansas City's having a problem with the San Francisco defense. The odds jumped up to like plus 290 for Kansas City. I mean, you put like 20 bucks on them, you'd win 58 at that point. And people are like, oh, no, just bet on San Francisco because they're only 10 points ahead now. They'll be like 30 points ahead in the second half. I'm like, no, like I might lose and you don't always win. But that's when I saw it as like, I'm going to bet now while the betting odds look better.
And there was probably a reason why you thought Kansas might win. There were probably cues that you saw that they were not out of the game, even though they were losing. Like they had a chance to win.
I've consistently seen them come back from 10, 15-point deficits. And I know that if they're kind of struggling in the first half, their coach always finds a way to like understand the other team better and know what their strategy is and find a way to counter that in the second half. All three of their Super Bowls, they've been at one point like 10 points behind and still won. The last 3 Super Bowls they won. It's the same thing with Bitcoin. Like people were panicking when it was like at 50,000 in 2021 and then just started dropping. And then it went back down to like 20, maybe 15,000. And I was asking some people I know who like know a lot about cryptocurrency. And I said, what do you think about Bitcoin? Is it going to go back down to zero? Because people who are panicking and selling like when it was low said, oh, it's going to crash. It's going to be gone. It's just going to dissolve. And everyone's like, no, Bitcoin's not going anywhere. Get it while it's low. And while I did lose money originally on Bitcoin, what I ended up doing was I started dollar cost averaging on that. I'd maybe get like $20 a week. It was a periodical investment. It wasn't crazy. I didn't go all in. I'm just going to start investing while it's low. Yeah, I know I'm putting more money into it, but it's got to go back up sometime. Sure enough, it went back up to 50,000. I know it went a little bit higher than that, or maybe 60,000 even. It was a pretty good amount. This was like back in March, and I was like, it could go to 70,000 or 80,000 because that's what everyone was saying then. It's like, oh, it's going to go to 100,000 easily. I was like, I could sell it now and actually profit a little bit off of it. Like, get the money I put on it back.
Just take the
and make a little
That's
bit.
Always a good idea. Too.
And let me, I'm selling. So I sold it, and then I was like, oh man, I made the wrong choice because it went up to like 65,000. But guess what? I'm just getting notifications now. It dropped to 55,000. So maybe it wasn't a bad decision after all. I mean, the fact of the matter is, don't try to time when all these like cryptocurrencies or stocks, when they're gonna like peak and stuff, because nobody really knows that.
Nobody knows. Yeah, nobody knows.
Keep contributing. I don't know as much about cryptocurrency, but I know with the market, just over time, like when you're investing, you got to look 30, 40 years into the future. Don't just try to think like 3 or 4 months from now how much you could get.
I mean, unless, like I said, unless you're day trading.
If you're day trading, sure, but
that's a different thing, and
story.
you should know what you're doing. It's a business and it's a job, and it's
exactly.
Kind of it's a different.
But for an amateur, day trading's probably not the best option.
It's probably the worst idea, ever. About the dollar cost average, you were saying that it was hard for them to figure out why the person that went all in didn't get the results that the dollar cost average, even when they put less money.
Well, they got higher results than the person who put a bunch of money on a stock that went up.
And what I was going to say is that if you're buying a stock that you think is going to go up, it's very, very likely that you're buying an overinflated product, right? Because if you're hearing about it, it's probably already high. It's probably overvalued.
Kind of like Amazon,
a lot of money
Google,
into it.
Microsoft.
The upside is not as good. Versus dollar cost averaging, you take buys during the bad times, pretty much. Even if it drops a little bit, you're buying at that price point. And so it averages out to bigger returns because you're buying more dips.
It does. And kind of like what I was saying, that even like Graham Stephan couldn't really break down the math. He's just the one that recommended it, especially to people who don't know a lot about investing, who think, oh, well, how is it possible someone puts $5,000 right here on a stock when it's low, and then it goes up this amount, and they still made less money than someone who was just maybe putting like $100 periodically on the stock. And then they still somehow came out to more, even though the stock was at lows and highs. You think it averaged out. You think on the surface, oh, if it's at like $1, then it jumps up to $10, your money should multiply by 10, right?
Yeah.
But then the person who dollar cost average did the same thing, like when it was at $2 or $5, and then even at like 50 cents, and they still came out with more. I can't explain it, but I
also, it's like a long-term kind of mindset. If you dollar cost average, you actually really do believe in the thing that you're doing, is because you don't have to worry too much about the exact price. You know it's going up. You don't know when.
Right.
You don't know how much it'll go down before it goes up. So you take care of.
It's not like
discipline.
you're trying to win the jackpot in a casino.
Right.
You have money. Usually it's
habit.
like for retirement. And that's
Yeah.
ultimately the end goal, is that you have a portfolio and your returns is what you can retire off of, so you don't have to work when you're 80.
I just want to remind the audience that this is not financial advice in any way, shape, or form.
Exactly.
This is for entertainment and educational purposes only. Consult with a professional before making investment decisions, and we are not liable for any financial decisions you make in the future.
That's right. So if you use Robinhood instead of Acorns, we're not
We don't care.
responsible. Yeah, we don't care either.
Hey,
But no,
Napoleon, that's been great talking about different topic today. A little bit of,
exactly.
I guess, a little more serious topic. Talk about finances and stuff. But I think it's fun that we kind of
Yeah.
deviate from our regular topics.
We're not necessarily the financial experts. You definitely have a wide array of knowledge when it comes to the markets and cryptocurrency, and just maybe some good and bad decisions on how to invest, depending on what your level is. Definitely something I need to get more involved in. It's definitely a smart idea for everybody, but the main point we can take away is that don't panic when it comes to investing. Don't ever get scared, and don't try to just make an easy profit. If you're putting money in and it looks like everything's going down and you're losing, like, don't panic and sell. Just stay in it, or even then double down like I do on sports bets when my team's behind.
And there's one investment that you can never go wrong, is if you invest in yourself. You can
Right.
never make a bad investment on that. So
And-
education, whether it's gym membership, books, you need a new computer, you need a new car, it's all investment in yourself. You can never make a loss on that end.
Another great investment is if you subscribe to the Napoleon and Gueco podcast, so you don't miss any more upcoming episodes.
Stay tuned, everyone.
Stay tuned. Peace.
All right, I'll see you later.
I hope you really enjoyed this video. Check out some of the other content we have on this page, and make sure to subscribe so you are always notified when new content becomes available on this channel. And I will see you in the next video.